Hi, David here, CEO and founder of the Freedom Founders Mastermind community. Nobody likes the party to end, particularly when it's been a good party, a fun party, engaged, vivacious, I guess you could say. And what am I talking about? I'm talking about the markets right now. I'm talking about the investing markets. We know that the market always cycles. There's always a cycle. Typically, every 6 to 8 years, we go through the upswing of the topping of a market and then downswing of a correction, and then back up again. And this has happened over decades and decades and decades, going back to the mid-1800s when we first were measuring market cycles. It's a given. This last one has been a relatively long stretch on the upside. We came out of the great financial recession back in 2008, really hit the bottom of it in 2010, 11, 12. We started climbing back out. And since that point, about 2012, we've been pretty much nothing but a straight upshot in both the financial markets, real estate assets, really every kind of asset you could look at. Why? Because of the overriding cheap money. The Federal Reserve has subsidized low interest rates for many years. They've been able to because we've had low inflation. We're seeing a change in the markets right now. If you're awake at all, you know that we've seen a lot of volatility since the first of this year. The financial markets always react first. They're the emotional markets, the markets that can go on a quick downside very, very quickly. It's been all over the board since the first of this year. The real estate markets are also not immune to the market cycles. It's just a different asset class. It's much slower to make the changes, and therefore, in my opinion, in my experience, much easier to follow the big waves and not get caught in these emotional cycles of the financial markets. That's why so many people have been looking at real estate really over the last number of years, because of the stability, long-term stability, if you do it right. Now, here's where the danger comes in. The party's been great over the last, as I said, 10 years. There's always Johnny-come-latelys to every upmarket cycle. In every asset class, there's always people who come in late to the game because everybody else has been doing it, and now they say, hey, I want to get in too. And that continues to push the asset bubbles up higher and higher as long as there's still margin left. Now, with the Federal Reserve raising interest rates right now, fighting the headwinds of inflation, the market cycle is tipping on the downside. We are there. It's still up and down, volatile as you watch and see, but I believe we're going to a pretty significant recession correction. What does that mean to us as investors? Particularly if you want to be more of a passive investor, you're not boots on the ground, you're not managing particular companies' assets, real estate, but you want to be a passive investor. How do you know where to plant your flag? That's the danger. Most people look at real estate investing as owning the asset, some type of ownership. Either you own the rental property or you put money into a syndication where someone else is running the operations of a multifamily facility or a self-storage or mobile home park community, but you're putting money into the equity side of the real estate. That's where all the upside comes from. Equity, yes, ownership. You get the benefits of profits that go up, of cash flows that go up. You get tax benefits, all those benefits. And it's great when we're in a growth cycle. What about when we're going through a correction? How do you position yourself then? See, most of the Johnny-come-latelys don't understand that. They've never gone through different iterations of the models. I've been investing in real estate since 1980. That's over 4 decades. I've watched these iterations. I've gone through my own market cycles. I've done it now with Freedom Founders for over a decade. And it's exactly how we position ourselves to know, do we take the equity side, the ownership side, or how about the other side? Well, what's that, David? I didn't know there was another side. Yeah, there's the debt side. Now, not debt as a liability, as we normally think of debt, where we owe the money to the bank, owe the money to the lender. No, this is where we get to be the lender. Instead of taking the equity position, which, as I said earlier, has all the upside, all the gains, what everybody likes in a frothy market, how about if we take a different position and we be a lender? Well, how does that work, David? Exactly. I thought people went to the banks to get their money. Yes, they do. But let me flip over to the iPad and give you a quick demonstration of what I call the capital stack. There's more to this, but I'm going to give you an overview. You can get the gist of it, even if you don't understand completely what I'm talking about. Follow me through on this. This is a diagram of a house. Yes, it's a very, very primitive house, but just look at the roof structure. You can see a house. And we're going to pretend like this is a large house, or let's just make it in the terms of a multifamily, an apartment complex. Let's say this is a pretty big complex, and the purchase price of this opportunity for this complex is going to be a total of a $10 million purchase price. That's the total purchase price. There's a sponsor or a manager who makes a business out of finding these multifamilies and tries to buy them at the best price and terms they can. So what do? They go and they can usually get about, give or take, 60% of the financing from a traditional bank institution. So in this case, that would be about $6 million. that means the rest of the 10 million has to be taken care of in another way. So where does that money come from? Well, the sponsors may put a little bit of money in, and that's important. Maybe they put in 5%. So that means they might put in up here, they may put in, 500,000, give or take. And then the rest of the capital, which is approximately 4 million or just a little bit under, is going to come from equity investors. Now, equity investors are always going to be paid second. Debt gets paid first. And that's why I'm saying to be a debt lender sometimes in a market which is going through corrections makes a lot more sense. Yes, there's not all the upside. You don't get all the tax benefits, but what if I just want to protect my capital and still get a decent return while we're going through a market cycle correction? Wouldn't that be like higher ground? Well, for me, it is. And I take a lot of these debt positions right now because I want to be a little bit safer. I will forego the potential that this market keeps going up and up and up and never stops, but the reality is they don't. There's always a time when the markets shift and correct. And that means as a debt lender, I can lend my money and get paid first before the equity above that on my diagram here, the equity again being in, let's make a different color here. The equity would be above the loan would be all this area in here. This would be all the equity ownership, and the debt portion would be down here. So if I want to play the game down here, I can get my returns and be secured by actually lending the money here and letting somebody else take that risk up here. That's the difference in knowing how to slice and dice the current marketplace. I still invest in both equity and debt, but in Freedom Founders, we get the advantage of having the leverage of our entire community, a lot of capital. So we get to look at a lot of different opportunities. And because of our leveraged position in the marketplace, we actually get to structure where we want to be in this capital stack. Do we want to take an equity position? Well, how does that look? Do we take preferred equity, common equity? What's the waterfall? Again, a term that you may not be accustomed to, but we get to negotiate these things. If we want to be on the debt lender side, can we have the debt position, the safe position, but also maybe have an equity play at the same time? Yes, it can be done. See, this is the advantage of knowing how the market cycles work, how to structure deals, and having the leverage of a lot of capital, not just being an individual investor out there who you pretty much have to just take what's given to you. If you want to invest in real estate and you're not going to do it yourself, then you're provided an opportunity to invest in this syndication, that syndication, that syndication, but they've already got it laid out exactly where you're going to be in that capital stack. Is that where you want to be in a cycle right now where we're going through the correction phase? I would say not. Don't be a Johnny-come-lately without having a positioning that allows you either through your own experience, or if you don't have your own experience, find others that do. Very important, because that's what's going to keep you safe and still profitable going through this market cycle. When do you turn back to more equities and more of an aggressive position? Well, after we've gone through a market cycle, assets go on sale. Do you have that positioning? Do you know who to call on? Do you have different asset class diversification, geographic diversification? These are all the advantages of real estate, a very inefficient market, but you've got to have the relationships, the access points. Exactly what we do in Freedom Founders. This is something that if you don't have that, you've got to be very careful right now as an investor, especially if you're Johnny-come-lately. If this is new to you and you haven't done it before, this is a time to proceed with extreme caution. There's going to be all kinds of opportunities, but you've got to know where to find them and how to set them up, how to structure them. That's where the sophisticated investor comes into play. Remember, stay focused on your freedom. I'll see you next time.